Hello everyone, this is Tuhun Jaman and my student ID is 2011137136 and I'm the student of Department of Banking and Insurance, University of Rajshahi. So today I'll be presenting on the exchange rate system of Bangladesh, covering its evolution, mechanism and policy implications. I hope this presentation gives you a clear and usual and useful picture of how Bangladesh manages its currency and their challenges and opportunities lie in it. So let's start. So in our site or in our presentation we'll see the interaction, why exchange rates matter for Bangladesh, historical evolution from 1971 to present, how the system changed especially, and so especially if we say the Bangladesh, the historical evolution of the system from 1971 to today. Third, how the current mechanism actually works. Fourth, the key factors that influence the value of the Bangladeshi Taka. Fifth, the recent challenges and the 2022 to 2024 forex crisis. 6. A comparative analysis with neighboring countries like India, Pakistan, Vietnam, etc. And finally, some practical policy recommendations. So let's start with the interaction. In our interaction, we can see to understand why exchange rates matter so much for Bangladesh, consider three simple facts. Bangladesh is the world's second largest garments, especially exporter. The country receives over 22 billion US dollar in remittances over 20 years, and 170 plus million people depend on stable prices in their daily lives. All three of these things are directly connected to the exchange rate. The Bangladeshi Taka or BDT affects how much exporters earn, how much it costs to import fuel and food, and how much inflation ordinary people face. Since independence in 1971, Bangladesh has gradually moved from a fixed exchange rate system to today's managed floating system, slowly giving more room to market forces. This presentation traces the journey and task. What should Bangladesh do next? So moving to the next slide, here we can see that uh, the historical evolution of Bangladesh. Now let's look at how the exchange rate system has changed over the past 5 decades. I like to think of this as 5 chapters in Bangladesh's economic story. Chapter 1, 1971, at independence, the Taka was pegged to the British pound sterling. This gave early stability but limited flexibility. Chapter 2, 1975, the peg shifted to the US dollar, which made more practical sense since most trade and aid was denominated in dollars. So in chapter 3, especially the 1988s and 1990s, Bangladesh went through multiple devaluation, often as part of IMF and World Bank structural adjustment programs. The Taka was deliberately made cheaper, especially to boost export competitiveness. Chapter 4, 2003. This was a big reform. Bangladesh officially moved to a floating exchange rate, meaning the market would now have a say in the Taka's value. And Chapter 5, 2023. As part of the IMF loan program, Bangladesh adopted a crawling peg mechanism where the Taka moves within a defined band. The key insight here is that Bangladesh has never fully let go of control. Every regime has involved especially active management by the central bank. So moving in the next slide, where we will see the current exchange rate mechanism in our country. So how does the current system actually work? There are three things to understand. First, it's a managed float. The Taka's value is primarily set by supply and demand in the interbank foreign exchange market, but it is not a completely free float. Bangladesh Bank actively intervenes to prevent extreme swings also. Second, Bangladesh banks role. When the Taka is weakening too fast. The central bank sells US dollars from its reserves to increase supply and stabilize the currency. When the Taka is getting too strong, which could hurt exports, it buys dollars to bring the value down. Third, the crawling peg introduced in 2023. Under the IMF program, the Taka is now allowed to move gradually within a defined range. This provides more transparency and a more predictable adjustment path. One critical number to keep in mind: at the peak in 2021, Bangladesh had around $46 billion in foreign reserves. By 2023 and 2024, this had fallen to around 20 to 25 billion, putting real pressure on the system. So now moving the next slide, where we will see the factors influencing the exchange rate of Bangladesh Taka. We can see the garments export, remittances, import cost, inflation gap, used strength, etc. are influencing in our exchange rate system in Bangladesh. Okay, so if we say in foreign direct investment and capital flows, FDI inflows support the Taka. Bangladesh attracts relatively modest FDI through export processing zones, and special economic zones are growing. Okay, so moving in the next slide, here we can see the story of Bangladesh's most serious exchange rate crisis in recent memory, 2022 to 2024. As you can see on the chart, the Taka was relatively stable at around 85 to 86 per dollar until early 2022. Then it depreciated sharply, reaching around 110 Taka per dollar by 2023. That is depreciation of nearly 28% in roughly 18 months, right? So what caused this? Three main factors came together at the same time. First, global commodity prices surged after Russia's invasion of Ukraine, right? Especially fuel and food sector. And the second time, we can see the US Federal Reserve hiked interest rates aggressively, strengthening the dollar against all emerging market currency. And third, remittance inflows through official channels fell as more workers used the Hundi system where they could get a better rate. C2 was a very challenge, especially at this time. Also, it's very challenge in our countries. So moving in the next slide, here we can see the comparison between our neighboring country. To put Bangladesh's situation in perspective, let me compare it with three regional peers. Look at the bar chart here. In Bangladesh had around $21 billion in reserves in 2023, while Pakistan had only 8 billion, Vietnam had only 86 billion, and India had over $600 billion. The difference is striking. Now the country comparisons. India operates a managed float through the Reserve Bank of India, similar to Bangladesh, but with much deeper markets, stronger institutions, and far greater reserves capacity. The lesson for Bangladesh is to build credibility and transparency in monetary policy communication, especially. Okay, in Pakistan is a cautionary tale. Its weaker reserves, larger fiscal deficits, and delayed reforms led to a much more severe currency crisis than Bangladesh experienced. Bangladesh managed its situation better, partly thanks to its stronger export base. Vietnam is perhaps the most relevant benchmark. It has a similar government-led export economy but has attracted far more FDI, diversified its export base more effectively, and built a substantially larger reserve. Bangladesh should look to Vietnam as model. So in the last slide, especially slide number 9, we will see some policy recommendation. Here we can see, based on everything we have discussed, I want to suggest 6 practical policy recommendations for Bangladesh. One is build larger foreign exchange reserve. Bangladesh should aim to maintain at least 4 to 6 months of import cover. Larger reserves give the central bank more room to define the Taka without panic. Then we'll see unify the exchange rate, boost official remittances, diversify export base, strengthen monetary, especially policy, and we can see manage capital flows carefully. Bangladesh should gradually open its capital account to attract more stable long-term FDI while keeping safeguards against volatile short-term speculative flows. So, if we just in our conclusion, we can see that to wrap up, let me leave you with 5 key takeaways. First, Bangladesh has come a long way from a fixed pound peg in 1971 to today's managed board, reflecting 5 decades of economic learning growth. Second, the 2022 to 2024 crisis revealed real structured weaknesses, low reserve, multiple exchange rates, and excessive dependence on the government sector. Third, the IMF backing, especially the crowding peg and the push for an ununified rate, so are positive steps, but they need to be sustained and deepened over time. Fourth, long-term exchange rate stability requires bigger reserves, a more diversified economy, stronger institutions, and a more credible monetary policy framework. And fifth, this is perhaps the most important point, Bangladesh's vision, especially the goal of becoming a developed nation, simply cannot be achieved without a resilient, well-managed exchange rate system. A stable Taka is not just a financial issue, it is a development issue. So thank you very much for your attention. I am happy to take any question. You can just comment here in my video especially. Okay, so now we will see the references in which I have already extracted the information here. The information in this presentation is drawn from reliable academic and institutional sources, including Bangladesh Bank's annual reports, IMF article, conclusion especially, and also consultation reports, World Bank data, etc., etc. So that's the recommendation and refers and sources. Okay, so thank you very much everyone, and thank you very much to our honorable teacher Shahaz Hussain sir to give us this kind of opportunity in the online presentation. So thank you very much.